Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Embecta Corp. Quarterly Report. Embecta Corp., a medical device company, offers a range of solutions for individuals living with diabetes worldwide. At the core of its offerings are medical devices such as pen needles, syringes, and safety injection devices designed to facilitate safe and efficient insulin administration. In addition to these physical products, Embecta also provides digital applications that assist patients in managing their diabetes. These tools likely include features such as tracking systems, reminders, and educational resources aimed at improving patient outcomes. The company's primary sales channel is through wholesalers and distributors, who then supply its products to healthcare providers and pharmacies. With a rich history dating back to 1924, Embecta Corp. has established itself as a trusted provider of diabetes management solutions in the United States and internationally. The stock price of Embecta Corp. has experienced a significant decline over the past year due to several negative financial reports and a concerning outlook for future fiscal years. The company's revenue has been impacted by unfavorable changes in sales volume, foreign currency translation, and increased costs. One of the key events that contributed to the stock price drop was Embecta's weak fiscal 2026 outlook. Despite beating some earnings expectations, the company projected flat to down 2% revenue growth on an adjusted constant currency basis, which raised investor concerns. The anticipated decrease in adjusted operating margin by approximately 180 basis points also added to the negative sentiment. The decline in revenue has been a recurring theme for Embecta, with a 7.7% drop in fiscal 2025 second quarter financial results and a 3.8% decrease in full-year revenues. The company's inability to meet consensus estimates in its fourth quarter of 2025 further exacerbated the situation, leading to a significant stock price drop. The recent fiscal 2026 first quarter financial results also showed a slight revenue decrease of 0.3%. with U.S. revenues experiencing a 7.6% decline. These negative trends have led to investor apprehension and a significant drop in Embecta's stock price over the past year. The Embecta Corp market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $1 billion. Embecta Corp trades at a lower price-to-earnings ratio of 4 times and a lower price-to-book ratio of -1.01 times relative within the industry. This suggests a potential market detachment, as Embecta Corp trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company exhibits a very high leverage profile, with liabilities accounting for 160% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 5.73%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through a review of various factors affecting the company's sales. One significant driver of decline is the discontinuation of the patch pump program, which resulted in a loss. However, this was partially offset by the sale of intellectual property rights and long-lived assets associated with the program. Another key factor contributing to revenue growth or decline is the change in sales dynamics across different regions. The company experienced a decline in United States revenue while witnessing an increase in international revenue. This shift highlights the importance of geographic diversification in mitigating regional market fluctuations. Product-specific drivers also played a crucial role in shaping revenue growth or decline. For instance, pen needles saw a significant decline, whereas syringes and safety products recorded increases. Contract manufacturing revenues decreased due to sales deductions related to non-diabetes products sold to BD. These product-specific trends underscore the need for companies to monitor and adapt to changing market demands. Lastly, unfavorable changes in price also contributed to revenue decline, with a decrease of $7.8 million. This highlights the importance of pricing strategies in maintaining revenue stability. Overall, these factors collectively influence the company's revenue growth or decline, underscoring the complexity of managing sales dynamics in a rapidly evolving market. The financial performance of a company underwent significant changes between 2024 and 2025. Net income saw a substantial increase from $0 to $44.1 million, primarily due to the correction of previously reported losses and an increase in operating income. This growth was also influenced by other comprehensive income and stock-based compensation plans. However, profit margins presented a mixed picture. The gross profit margin decreased slightly from 60% to 62%, while the operating income increased significantly from $28.7 million to $83.3 million. As a result, the operating margin rose to approximately 32%. Notably, the net income margin improved dramatically from -0.26% to 16.9%. These changes indicate that despite some fluctuations in profit margins, the company's overall financial performance showed considerable improvement. The company's financial performance indicates a healthy trend in its ability to generate cash from its core operations. According to the latest figures, the company has achieved a positive operating cash flow of $17.2 million. This is a significant milestone, as it suggests that the company is able to cover its operational expenses and invest in growth initiatives without relying on external funding. This achievement is a testament to the company's efficient management practices and effective cost control measures. The positive operating cash flow also provides the company with the necessary liquidity to pursue new opportunities and expand its business. Overall, the company's ability to generate positive operating cash flow is a key indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt outstanding has decreased by $26.4 million in 2025 compared to 2024, indicating a reduction in the company's debt burden. This decrease is consistent across multiple reports, with long-term debt decreasing by $35.8 million from September 30, 2025. In terms of interest expenses, there has been a notable decrease as well. Interest expense, net decreased by $3.8 million, or -13.6%, from $-27.9 million to $-24.1 million in 2025 compared to 2024. This reduction is attributed to lower payments on finance leases, which implies a decrease in interest expenses. The impact of these changes can be seen when examining the interest expense as a percentage of operating income. In 2025, this ratio decreased significantly from 97.2% to 29%, indicating that the company's interest expenses are now a smaller proportion of its operating income. Overall, these changes suggest that the company has made progress in managing its debt and reducing its interest expenses. The recent financial analysis reveals mixed results across different regions and segments. In the international region, there was a notable increase in revenue, rising from $120.2 million in 2024 to $130.3 million in 2025. This indicates strong growth and better performance compared to other areas. On the other hand, the United States segment experienced a decline in revenue, dropping from $141.7 million in 2024 to $130.9 million in 2025. This decrease signifies poor performance and a need for improvement in this region. Management's outlook for the company is cautious due to significant competition in the medical device industry. The company faces pricing pressures from regulators and a shift towards volume-based procurement, which may impact its global distribution strategy. However, management believes it has sufficient financial flexibility to fund its needs and is focused on growth through various initiatives. The company's business model involves selling products to wholesalers and distributors, who then sell to retail and institutional channels. Management is evaluating the impact of new accounting standards on the company's financial statements. The decentralization of chronic care will lead to a shift in healthcare delivery outside of hospitals to primary care providers, which may present opportunities for growth. Management is monitoring global events such as conflicts in Ukraine and the Middle East, but currently sees no material impact on business operations and financial performance. To drive growth, the company is implementing restructuring plans, including the Patch Pump Restructuring Plan and 2025 Restructuring Plan. These initiatives aim to improve efficiency and increase revenue through volume growth, pricing, sales, and earnings per share growth. The company expects to incur material costs associated with operating and maintaining its information technology infrastructure over the next several years. Despite these challenges, management is confident in the company's ability to fund its needs and achieve its growth objectives. The company has made several significant moves in terms of acquisitions and divestitures. In terms of acquisitions, there are no notable mentions in the extracted summaries. However, the company has engaged in various divestiture activities. One of the key divestitures is the discontinuation of the patch pump program. This move suggests that the company has decided to exit a particular business segment or product line. Additionally, the company sold $56 million worth of trade receivables during the 3 months ended December 31, 2025, indicating a strategic decision to liquidate certain assets. The separation from BD is also mentioned as an expected benefit, implying that the company has undergone a significant restructuring process. Furthermore, the Patch Pump Program Restructuring Plan and the 2025 Restructuring Plan are highlighted, suggesting that the company has implemented various plans to reorganize its operations and improve efficiency. Overall, these divestitures demonstrate the company's efforts to streamline its business and focus on core activities. The company has a history of paying dividends to its shareholders. As per the records, it has been consistently paying out $0.15 per share in dividends. This indicates that the company is committed to rewarding its investors through regular dividend payments. On the other hand, there is no evidence to suggest that the company has engaged in any significant share buyback activities. Despite having the financial resources to do so, the company has chosen not to repurchase shares from the market, suggesting a focus on investing in growth opportunities rather than returning capital to shareholders through buybacks. Concerns about inventory buildup and supply chain disruption are valid and widespread. One of the primary concerns is inventory buildup, which has increased significantly as companies attempt to mitigate potential supply chain disruptions. This buildup can lead to inefficiencies and wasted resources. Supply chain disruption is another pressing concern, driven by several factors. Constraints and inflation within the global supply chain have created significant challenges for businesses. The disrupted availability of raw materials, components, and other essential inputs necessary for manufacturing and distribution has further exacerbated these issues. Additionally, tariffs imposed on imported goods have resulted in additional costs and potential changes in sourcing decisions by foreign governments and private purchasers. The introduction of new tariffs and trade policies also poses a significant threat to supply chain stability. These policies can lead to disruptions in the flow of goods and materials, causing delays and increased costs for businesses. Overall, the current state of the global supply chain is precarious, with multiple factors contributing to potential disruptions and inventory buildup. That concludes the financial summary. For Embecta Corp, feel free to comment below, and I will be happy to answer them when possible.